Welcome to the Market Huddle with Patrick the Content Machine Serezna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's March 22nd, 2019, episode number 20. I'm Patrick Serezna.
And I'm Kevin Muir. Thanks for joining us this week.
Now, this show is broadcast as both a podcast and available on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website or get the weekly email, which includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we welcome Angie Setzer, the goddess of grain. And then Patrick and I chat about the FOMC meeting. In our Tales from the Trading Desk, we hear from Angie about learning the hard way.
And in this week in trading history, we go back 400 years for what I think is one of the best stories we've had yet on this show. And then we'll end with the top 5 most important things to watch next week. So let's jump right to it.
So who's it brought to us by this week, Patrick? Actually, I'm going to do it. So it's Bench Brewing Company was kind enough to sponsor us this week, and I'm just going to read about we're drinking their Session IPA, and it's named after the historic waterfall of Balls Falls, located in the heart of beautiful 20 Valley. It's a dry hopped for a juicy aroma of peaches and citrus. Ooh. It's highly sessionable, whatever that means. It's one of these millennial things again, with a soft bitterness that delivers a balanced dry finish with a hint of, guess what, Patrick?
Oh, I
pick an evergreen. It's another tree.
Another tree.
Cedar. Yeah. Oh. And the suggested pairings are buffalo wings, Indian curry, and Mexican food. Okay, right. Let's jump in.
All right.
Okay.
Oh, it's definitely fruity. Oh, it's
okay,
it's definitely fruity.
Can you taste the cedar?
No, actually, I can't taste the cedar, but I can.
Okay.
I got a mouthful of fruit. No, but
okay. We'd love to welcome Angie Setzer from Citizens Elevator LLC, and she is better known as the Goddess of Grain. And I believe Angie is one of our kindred spirits. She's also going to be drinking during this podcast. What are you drinking, Angie? And welcome aboard.
I'm as basic as they come. I've got some white wine in my nice little John Deere glass with a straw that I'm drinking out of. So.
Did it come in a box? Did your wine come in a box, Angie?
No, I at least had to open it with a real corkscrew like a grown-up. So that's I've got that part nailed down. But after this week, I'm skidding into 5 o'clock, just happy to be whole. So that's the story of my life.
All right, well, Angie, we have to let Kevin do his disclaimer quickly here, and then we'll get into some great conversations on grains.
Okay, here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include blue waffle, bugs in the rug, fake and shake, and or failure to thrive in adulthood. Please see a doctor if any of these conditions persist.
I have those conditions, so it's going to be a problem.
The failure to thrive in adulthood?
Yeah, that's definitely my problem. Anyway, so welcome aboard, Angie. So listen, what we do here is we always ask our guests to come on and talk about some of the most important things that they think are going on either this week or just in the markets in general. So what's on your mind?
Oh, goodness. I mean, for one, I have China headline fatigue, so we could avoid talking about China headline and I'd be a pretty happy camper on that one. I mean, that was a big deal, but I think the biggest deal of the week this week has been all of the flooding that we've been seeing in the Western Corn Belt. You know, parts of Nebraska have been completely underwater.
Yeah, I have a chart here for you.
There you go. Yeah, you can see all of the areas in purple right now are really struggling. Some of them in the northern areas, the Dakotas specifically, haven't necessarily seen that big chunk of flooding coming yet. One thing that's really interesting there, if you look at the purple up by North Dakota and Minnesota and how it doesn't move south, That's the Red River Valley, and that actually moves north. But the areas highlighted in purple there in Nebraska, Iowa, parts of South Dakota, Missouri, along the Mississippi River there, that's really one of the key production areas in the United States when it comes to corn, soybeans, and they had a lot of grain stored, and a lot of property damage done, and we're about 4 weeks away from really getting rolling with planting, or when we're supposed to be rolling with planting. And so a lot of folks are really kind of looking at that, and it's damaged a good percentage of our ethanol production right now. Either plants are just offline or they can't move product. The rail sidings, your railroads have been washed out. I mean, it's a mess. And so most of this week we've been kind of just trying to wrap our arms around what it means, wrap our minds around, the loss of life, the loss of animals, the loss of property, all of those things. So that's really been kind of the headline of the week. And then also we've been watching the commitment of traders, and, just what's taking place there with that big short in the commodities across the board as well. So several things starting to happen. We're, going into the busy time of the year, you could say.
Yeah, I have to ask you,
Yeah.
because I naively, my first impression is when I see something like this, I would be thinking that when I flip over to the charts that we should see substantial price response to this. And I feel like I wouldn't never have known looking at the charts that something like this is happening. Why are we not seeing this translated in the prices?
There's a couple reasons. I mean, first and foremost, we have relatively large supply available to us. We have a good amount of corn. We have about 1.8 billion bushels. The lower end of what we like to see is about a billion. So we have nearly double the amount of corn that you could say is low on the pipeline side of things. We have a historically large carry out in soybeans at this point in time. So that's really, for one, keeping a big damper on the market. For two, it is early yet. It's kind of a running joke in the commodity side of things that everyone always says it's early, but it is. It's only March 22nd. And so if the weather were to turn warm and dry, you would be amazed at how quick we can get this water to run off and dry out and things of that nature. However, we aren't seeing the forecast turn warm and dry. We're actually expecting it to stay relatively cool and wet. But we do have a record large short position, or did. I haven't had a chance to look at commitment of traders from this past week here. We had a record large short on corn. And so people are going to try to protect that. Corn and wheat, the speculative position is extremely short. So it takes a lot longer, to kind of turn the ship when everyone's already on one side. So it is a little bit surprising. I had a lot of farmers come to me and say, why isn't this market reacting to what's taking place? And obviously, the market structure in and of itself doesn't necessarily know how to handle too much moisture either. Droughts are a little bit easier. You can see pictures of what droughts do, too much rain. At least over the last several years, we've discovered, typically where you have too much moisture, you have, just the right amount elsewhere. Obviously this is quite a bit different, but we do have a few weeks yet before we really will get concerned over what's taking place.
So, Angie, it's Kevin here. So I'm just pulling up the CFTC commitment of traders on corn, and it looks like it's basically unchanged. It's still hovering just a little more than 100,000 contracts. One of the things that I must admit to being a long-term frustrated grain bull, and one of the reasons is that when you adjust it for inflation and look at this, it ends up being one of the few commodities that is kind of scraping along all-time lows, and especially when it's adjusted for inflation. And yet it just doesn't seem to be able to muster a rally, and it's just one of those things that it's almost like buying VIX. It's just continually a loser. Mm-hmm. And I was just wondering what your impression of why that is, and are we ever going to see this change, and are we ever going to see some sunny days ahead for the farmer?
Yeah, I mean, I think you've answered your own question to a certain extent because you are a frustrated grain bull, and everyone that's tried to buy this market since 2013 is in the same boat, right? So why would you come in and buy corn when the most you're going to get is a 10% return on your investment if you're lucky within a 10-day investment structure when the outside markets have been offering volatility and opportunity? Even soybeans have been offering volatility and opportunity, even if they're trading on the lower end of their recent range. Wheat's had some some significant ranges that it's allowed folks to capture some decent gains and some decent losses if they went the wrong way. But corn, really, I mean, it's about as tight of a range as it can get. I think since 2000, I mean, you look at this right now, and obviously, you're looking at a high side on the continuous at 412, where on the low end you're looking at like a 336. I mean, you really are not seeing much in the way of big ranges over the last 2-3 years here. 3 years, I think we've traded about $1.25, and that's happened over an extended period of time. Most of the time, though, we've spent trading, in this 10-cent type, 15-cent type range. And so I think that's one of our problems, is that we have a lot of frustrated folks that have come in and tried to trade it. And so, you could sell. I'm reminded of the Wayne's World, where Frampton comes alive. Frampton comes alive. That came from samples of Tide. You know what I mean? And like, that's the corn futures. They're a sample of Tide. No one gets excited anymore about buying corn just simply because there isn't a story. Now, I, for one, feel that there is a story and it's developing. We really were delayed in fall field work here this past year. A lot of farmers in the Western Corn Belt, those areas that are flooded, like to do most of their spring prep work, believe it or not, prior to winter. So that means they go out and they, disc the fields and get them prepared for planting season, several months ahead of time. They didn't get to do that last year because weather was so poor in the fall. So we really, really needed this nice, dry, warm March, really, to get caught up and be able to plant the 94 million acres of corn everyone was anticipating we were going to plant 6-8 months ago. So that hasn't happened. And if you look at some supply and demand outlines when looking ahead and take a look and play around a little bit with some planted acres and drop them down, maybe closer to where we were last year, and start factoring in supply and demand and what we're looking at on the demand side, you'll find that we'll really, really cut into that carryout. I mean, our demand is pretty phenomenal. There's some questions as to whether or not Brazil and Argentina will be able to provide, large crops in order to compete with us from an export standpoint here the last half of the marketing year, April 1st, May 1st going forward. That looks like it's likely to happen as well. But reality is we could see this carryout drop significantly. And at this point in time, I would argue that there's almost zero weather premium in place. So I think corn is setting itself up for, an explosive move higher. But I've also been feeling like that for the last 8 months or so. And it seems like every time we just need one more confirmation of a piece in the puzzle or something like that, the USDA, gives us a lump of coal. So that's also been a frustrating thing. We'll get folks bulled up and we'll start to see some investment movement and the speculative interest starts to grow and we get a negative USDA report or something like that. And so, it's like Lucy and Charlie Brown with the football. Eventually you just stop trying to kick it, I think. And that's where we're at right now.
So I see on Twitter a lot of the U.S. Twitter farmer guys will talk about the USDA numbers being flawed. Mm-hmm. What are they talking about when they say that, and what are the alternatives to the USDA numbers?
I mean, there is this big argument that there's no way that the USDA can wrap their mind around what's taking place or their arms around what's taking place, and they survey and yada, yada, yada. And, I for one, am of the belief that is it perfect? No, but it's hard to be perfect when you're talking about numbers in the billions. I mean, we're looking at 15 billion bushel of corn spread across 15 states. It's not really something that is easy. You're not going to go out and count every kernel to get 56 pounds per bushel to get all of the bushels factored in. You know what I mean? And so yeah. There's obviously going to be some slush. I mean, that's just the way it is. I, for one, believe that there's no one out there that could do better than the USDA, I guess, at this point. They're not for profit, though. a lot of folks will argue that their job is to try to eliminate volatile periods and pricing, so maybe they do come out and say certain things or do certain things in order to really try to eliminate swings. But I, for one, I take a look at what the USDA has to say. There's certain reports that I maybe do not put as much validity in. I'm not a big fan of the weekly crop condition reports. We'll get those out, and a lot of folks will try to extrapolate what crop conditions mean for final yield numbers. I don't think that's something that I'm not going to waste my time doing it. I'll let other people tell me what the numbers look like. But I believe that the monthly reports give us a solid indication as to what's taking place, and then I'm a cash trader, so I'm on the ground level, and I just pay attention to what the cash market's doing, really when it comes down to it, to tell me what is actually out there or moving, in the countryside.
Right. So, Angie, I have this smart client of mine that insists that when I try to pitch him on getting long some ag names or doing any trades on this, he's convinced that the efficiency amongst farmers in terms of increasing yield is going to make this just a non-starter from the long side. What would you is he correct? Is this going to just be something that the prices of all these grains over the next kind of 5-10 years is just going to continue going lower as we get more and more efficient, or are we finally hit a point where the majority of the efficiencies are kind of already priced in there or already happened, and there's a potential for a real spike in prices? Like, could we see a beans in the teens kind of rally that excites everyone? And right now nobody talks about grains, but there was a time that grains were exciting and that a lot of people would trade them. Will that ever happen over the short run?
Yeah, I think so. Beans in the teens will really be a struggle at this point, just simply because we've introduced so much more bean production out of South America. Now, I'm not saying, I've always been taught never say never in commodities, never say never in always, actually, because nothing never can happen, and it doesn't always happen either, and so, I mean, in the next 5 years, could you potentially see beans in the teens again? Sure. I mean, there are a lot of extenuating circumstances that could develop. There's a lot of, production. You go into every year not knowing what's going to happen. And, you just kind of take your best guess using your historical view of what has taken place. Now, corn, like I said before, we're really behind on fall field work. We've seen the cost really increase when it comes to fertilizer and chemicals, pesticides, things of that nature. So I am one of the believers that over the last several years, with the increase in corn yields, you've seen a lot of folks really try to work their way out of low prices via yield. So obviously a farmer works on revenue per acre, not necessarily price per bushel. And if he or she is able to maximize their yield potential, they're able to really kind of withstand some of these losses. You're looking at 150 bushel to the acre at 350 is 525, where at 200 bushel to the acre at 350, you're $700. So you really want to try to yield as much as possible. And I think a lot of folks have been spending the extra money to try to really kind of nail that high end yield that they're getting. Well, now, everything continues to get more expensive. The price of corn, if you look at the chart over the last year, hasn't changed at all, but the costs have increased 10 to 20%, depending on where you're located. So
Right.
You've got to start cutting corners in places.
Right.
So is corn your favorite long? Is that what I
Yes.
take that to mean?
Yeah, corn is
Okay.
my favorite long right now. Corn and wheat both. Corn especially, I think wheat is to July. Soybeans right now, I think they're just there, honestly. They remind me of the clown in It, everybody floats here. Because I mean, there's been a lot of folks that have been expecting soybeans to just absolutely collapse, and we have not seen that, whereas wheat has absolutely collapsed if you look at the chart here.
Well, so that's what I was going to ask you about there, Angie. So this is Patrick here. So,
Yeah.
let's talk some technical levels and some trading as a.
Here come the squiggles,
Well, no.
Angie. Get ready. Here come the squiggles.
Well, no, I just I'm looking at this drop that happened here, right? I mean, we saw a considerable drop in wheat prices in a very short order. I mean, this all happened in the 2019 year. First of all, I wanted to ask you, like, what was the primary driver behind this drop? And is this in your mind like a bottom? Is this an opportunity where you can come in there and scoop up some of this wheat for a rebound back to 2018 ranges?
Yeah, I believe so. I mean, one of the if you look at it, it was actually in the month of February too. And if you look at your daily, the colors here on your spiffy little chart, you had like one day where we saw some strength. And if you look at I wish I could show the mouse there, but the day in February, yeah, right there where you're hovering over. If you look at that, 483 had been the previous low. If you go back into that July timeframe,
Right.
you had seen that 483 really kind of be the support. And so when we failed at 513 and worked our way towards $5, I had totally anticipated that 483 would be our stopper. So I really wasn't too concerned. I was like, 483 has been solid support for, several months now. I really don't expect us to absolutely fall out of bed. And then we did. And not only did we fall out of bed, we fell out of bed pretty hard. But if you look back at where we had been a year ago from today, so you can see there that we had actually traded down to, we had broke the $4 range at one point. So we managed to stay above that when we rebounded here this most recent time. And I think, when it really comes down to it, there's a reasonable amount of carryover that's left over here in the United States. But I really question what our new crop production is going to look like. I fully anticipate we will try to rework our way back up towards that 483 level. We closed today, right around that 465 or so. I think that, as long as we can maintain that support, we'll try to test that 483. If we can break it, we'll obviously work our way back up towards 5.
That's the short-term technicals, but do you think that it's realistic for us to be north of 5 later this year on a sustained basis?
Yes, I think you'll be surprised. I think that what I've been telling most of my growers is I fully believe they'll have an opportunity to contract 525 to 550 cash wheat again before harvest gets here. And maybe I'm speaking my position, maybe I'm speaking my backyard, and that's totally, I'll embrace it if I am, but I'm looking at what's taking place from a production potential standpoint, specifically in soft red wheat. And, you go into Ontario, their market's down, their acres are down, their production potential is down. The guys I have that planted wheat this past fall planted it late, planted it into very, very poor conditions. We had a very poor winter. We were warm and open for most of the first half, had some ice, and then stayed frozen for a while. And so the wheat crop winter wheat sleeps through the winter time, but it has to sleep with, it sleeps better with a blanket, right? And so we didn't really get that decent snow on it. We ended up with ice, and then we got some snow. And so the one thing that I've seen since the melting has taken place is that a lot of the wheat really did not make it through winter very nicely. And so, obviously that could change relatively quickly here over the next couple weeks, but folks are starting to make decisions on whether or not they're going to fertilize this crop or tear it up. And most of the customers that I'm working with right now are telling me that they're probably going to end up tearing it up. They have some hedges on. We traded $6 wheat futures last year for 19. July 19 traded, during July of 18 last year, where you see that spike there on the continuous chart where we were 580 or so. These guys were able to lock in $6 plus futures for this year's crop. And they did, but that's still not enough to encourage them to go out and try to harvest a crop that's looking really poor. So I think our production will be down tremendously from last year. I think our carryout will be down from the year prior going into new crop. And so I think, there's some opportunities for explosive upside, but it's probably got to come from something happening maybe with the conditions in Russia or something like that. I think we struggle with getting our arms around what U.S. production potential looks like, but we do really well with trying to think of someone else having a crop failure. So we'll have to watch what takes place in the Black Sea region. But generally, that's what spurs a rally, and that's what kept us supported throughout much of this year, is the idea that Russia was going to limit wheat exports, which they never did.
Well, how about just the price levels here on corn? Like now, corn held up much better. Obviously, did not make it all the way down to the lows like wheat did. I mean, does that bode well for corn? I mean, are we heading back to that over the 4 level on the upside of corn in your mind?
I think so, yeah. Yeah, I think so. As we move ahead, I think we're back above 4. I think December corn's probably the better buy just because you'll have some more time. Right now, D's corn's trading in that 396, 399, $4 range. And I think I wouldn't be surprised to get 30 cents or more of upside on that thing at some point in time, maybe even a little bit more than that, depending on what the weather looks like and if we do see that continuation of cold and wet here in the month of April.
And just finally, we'll just get an update here. Obviously, you're not as optimistic on soybean, but do you still see the potential that it could break to lower lows, or is that pretty much in your mind where the bottom is just not as much upside?
It really is going to depend on what we end up figuring out with planting. I think the upside's extremely limited either way. I don't know for sure if we need to see a complete collapse in futures, until maybe we get a better feel for what the Argentina crop looks like. We're about halfway through the production season there. Things look pretty good right now, but Argentina did take a quick turn for the worse a year ago, and really lost that production potential. The problem with soybeans right now is, for every reason that I'm bullish, corn is really a bearish soybean story. So if you're looking at thinking that corn acres don't get planted because it stays cold and wet, you can plant a soybean. In 2015, we had folks planting soybeans into July. So there's a lot more time to get a soybean in the ground than there is corn. And so that's one of the things that'll probably continue to weigh heavy on that market structure here as we move ahead.
So, Angie, I'm going to ask you, even though you're sick of talking about China, I'm going to ask you anyway. Like, I've been kind of amazed that Trump is trying to get this, to sell a commodity, and he views this as a big win. When we sell to China, doesn't like somebody that was going to buy from us just going to go and buy from Brazil or something? Like, doesn't it getting China to buy any more of a commodity product? Doesn't that really not accomplish anything?
Yeah, I mean, for the most part, it really is one of those things where um, it's kind of like forcing someone to be your boyfriend. I mean, we've had the business with China, you love me, squeeze them really close. But, we had the business with China because we were a low cost, high quality, reliable producer. And that's what we've been. If they needed beans, we provided them, and we got them to them when they needed them. Brazil's got a reasonable production potential. Argentina exports soybean meal primarily. They tend to export the crushed product, not the whole product like Brazil and the US does. And so, yeah, I mean, we want to see China come in and agree to buy, but the reality is some of these numbers that have been floated around, the 1.2 trillion or the 3 trillion or some of these giant numbers that have come out, oh, China's going to buy all of their beans from us forever, those types of things, that's probably not likely. That's just a headline, which is why part of the reason that we're really dealing with this headline fatigue is that some of the headlines that are coming out really have no base in reality. They're just kind of there. It makes you wonder, where they came from. But as a whole, I mean, obviously, we just kind of want to be back to where we were, in the industry. We just want to make sure that we can rely on them wanting to come in and import our soybeans at harvest time when we need to move them the most. And to be completely honest, I think we've probably ruined that. That's not a political statement. That's just a statement, at this point in time, they figured out that they could live without us this last fall. They figured out how to kind of ration back their demand and are now kind of purchasing soybeans. And it goes back to what I've said for quite some time. You don't rush out to Walmart and stockpile washcloths because Walmart's always going to have washcloths, right? It's the same with China and soybeans at this point. If they have a feeling, or if they know that we're always going to be always have soybeans available to them, and if we don't, Brazil will, they're not going to come rushing to us and front load their purchases like they used to. So I think the market structure as we know it when it comes to the export side of things has probably changed significantly. I don't want to say forever because you never say never and never say always and never say forever in commodities, but it's going to be a long time before we see it change again, and it'll take some sort of major production issue in one of the two hemispheres to switch up what they're doing.
Angie, you went too fast with me on that line, but I'm going to go back and listen to it because sounds like it's one that should go into my vault. Okay, so for those who want to stick around and hear more about grains, make sure you go to the end of the show for the after hours with Angie. But in the meantime, we're going to ask Angie to tell us a tales from the trading desk of kind of a story or an experience that she had that people might find interesting. So go ahead, Angie. Why don't you tell us about it?
Okay, so the first company that I worked for, I've always been a cash trader. So a cash trader in grains means I handle the physical commodity. My job is to move it from the farmer to the end user. So the first company that I worked for, we did not own any bins. So those shiny steel things that people fill with grain, those are considered assets, and they help you, when it comes to important things like lines of credit, which you need when you trade anything really, but specifically commodities, especially the physical product. So we did not have those assets, and we basically were operating with about $100,000 line of credit going into 2006, 2007. I'd have to look at the years, but this happened, I believe, in 2009. We were going in, and the market started to rally. So obviously, when you buy grain from a farmer, you short the board because that's you're long the physical, so you're short the paper. And so as the market started to rally, our margin calls started to add up, and we quickly ran through our $100,000 line of credit. And so in order to keep those contracts open and to survive, we started to pass our hedges off, which simply means that you sell or pass your futures off to an end user. And the end user we happened to choose at that point in time was VeraSun. And for those of you who may not be familiar, VeraSun's the ethanol plant that went bankrupt in the fall of, I believe it was 2009, it could have been 2010. But in any event, we had a bunch of $6 contracts with them that we were carrying for our customers that they were writing at the time. And as harvest grew closer, we started to hear more rumblings about what was taking place and that the company wasn't doing very well. Something about, doubling down at the top or something of that nature. And so we started to talk to our buyer about what was taking place, and he was assuring us, you're okay, nothing to worry about, you're perfectly fine. And they filed bankruptcy. So what that meant is that we were not allowed to deliver any grain because we were a commercial. So we had to sit back and wait and watch our $6 contracts basically be torn apart by the bankruptcy court with the market at $3. And we had farmers who were relying on us to kind of fund.
Wow.
They had written a $6 contract with us. They had not written a $6 contract with VeraSun or anyone else. So obviously, they were anticipating to receive $6 for this corn, and the board was at $3. And so we spent a lot of time trying to figure out exactly what we were going to do and not go broke. And we finally, one of the brothers that I worked for came up with a plan that if we could go to all of our customers, we had about 200 customers at the time, and ask them to take a small haircut, it was about 7.5% off from each contract. So not the $3, maybe 45, 50 cents, depending on the price that they had. If they were willing to work with us like that, we could stay in business. We weren't going to make any money. We were basically going to break even for the year, but we weren't going to go belly up. And so I had to stand in front of a group of farmers, and one asked at the point in time, well, why should we do this for you guys? It's not our fault. And, I was late 20s. I had to basically answer that, so I can have a job, like, I need to work here. And they did, and we made it. But I learned a lot about counterparty risk and, knowing who you're doing business with and not assuming just because they're one of the largest ethanol players in the country that they're, solvent when all is said and done. And you just, one of those things where you just learn a lot in a short amount of time, and that was really what that experience was.
Wow.
How many farmers said no? Or did they
2.
all agree?
No,
2 out of how many?
Out of about 200. So
there you go.
That's why
salt of the earth. There you go.
Yeah,
salt of the earth. Yeah.
Agriculture, because it really wasn't. We could have done it. We would have just had to, the business would have had to have taken out a loan. And we did have one gentleman in the area. He was in a similar situation to us. He did end up going. He didn't go bankrupt. His customers wouldn't allow that either. Like they they worked with him, but he was no longer in business after the issue happened because he was same thing. I mean, that was just commonplace. If you ran out of a line of credit, and this was during, there were major elevators. CoBank was looking at shutting down or blowing, co-ops out of these positions because no one really understood the risk that we weren't used to it, right? Prior, if you look at a chart from, 93 to 2007 or 2006, you had like a 50-cent trading range in grains, so this new $3 risk with, shorts on and having to margin that. We've sent several millions of dollars in margin calls to Chicago when the market really got crazy. It was a whole new world. So it was definitely something you learn how to manage risk and know who you're getting in bed with. That was for sure.
That's a great story. Thanks a lot, Angie.
So again, just for our listeners, if you want to hear more from Angie, she will be in the post after we wrap up the main part of the show. Now, we also have another housekeeping announcement. Kev and myself are going to try something daring. Wouldn't you say, Kev?
Daring.
I like that.
Yeah, that's funny.
Well, we'll see. What we have decided to do is we are going to go after next week's show on March 29th. We're going to go to the Elephant and Castle in downtown Toronto, which is at 212 King Street. We'll probably be there sometime after 8 o'clock. And we're going to sit there and we're going to continue drinking after we recorded the show. And
because we figure that we don't do enough drinking during the show.
We don't do enough during the show.
On that note, by the way, here's my third.
Oh, okay. Wow. Okay. You're on. I'm still on my first, so I'm like totally behind you. This is embarrassing. But with that said, we're opening it up for any of our listeners to come join us. It doesn't matter who you are. It doesn't matter what trading experience you have. If you listen to the show and you're a fan of it and you just want to come and hang out with Kevin and myself, we are making this an open invitation to come out and join us. No cost, no nothing. Just show up at the Elephant Castle. We're probably going to do the bar or the extra bar at the very back of the restaurant. So you have to walk past the main part. Come to the back and just look for us. If you don't know what we look like, good luck. But but anyway, it's going to be a great time, isn't it, Kev? Okay. It's going to be so fun meeting so many of our listeners. So we're looking forward to that. For sure.
Come on by. It's going to be a lot of fun, and we'll get some beers.
You know what?
We'll have some we'll trade the – listen, we'll do the true trading tales that we're not allowed to say on air. That's what I promise. That sounds
awesome. And we'll try to get some pictures, and we'll share them maybe on our website or something.
Okay.
Next time. Anyway, now let's move on. So, Kev, we had to talk about the FOMC meeting in Powell. Like, I know we seem to always be talking about this, but it was, again, another major meeting, wasn't it?
Oh, it was epic.
Epic.
I think that's the word to use, epic. And you know what I like about this is that we're on completely different sides of the fence.
Right.
You're like, I must say, I was away on vacation and I got to see your tweets, and I saw your tweets, and
I took some flack.
Apart from all the zero hedge retweets, that you just seem to be the biggest conspiracy like tinfoil hat guy. But apart from all the zero hedge retweets, I saw the fact that you thought that the Fed must know something because they are going dovish.
Okay.
And therefore you should sell stocks. Am I getting your tweet right, Patrick?
I asked it more as a question, but no. Here's my thing. My whole issue is about the fact that I don't think it is bullish the way everyone thinks it is. The fact that
whoa, nobody thinks it's bullish. Everyone, you're in the majority. So, anyways, go on.
I think it's quite bearish.
Yeah. Okay. I would say you're the majority, but anyways, you can go on. Okay. So I shouldn't interrupt it. I'm sorry.
No. But for me, I think that the logic behind it, and especially some of the comparisons that are made about that this could be a 1998 style blow off to the upside, which I think we're going to put up some charts here and talk about here in just a moment. I'm just not ready to drink that Kool-Aid, and I won't do it. I'm telling you right now, I'm not going to drink that Kool-Aid. This still, look, I built a narrative at the start of actually in the middle of last year when I first started shorting the market. And I've been on the sidelines since the bottom, right? We talked about this. And
No, you're absolutely right. You've been nailing it.
And I
to
still
be fair,
am very, very interested and actually am already shorting the markets. And I don't
There
think...
we go, folks. Whoa. We got to stop there because I had all sorts of questions whether Patrick was pulling out the pink tickets.
Oh, no. I don't
they've-
even know. I can't even see the color blue in my eyes. All I see is pink. All I see is pink. And now, with that said, what in the Macro Voices podcast, I actually was talking about how I'm putting on the trade with these calendared straddles, which is I'm hedging the fact that the market may rip to the upside. But I've got an anchor, which is that the bias to the whole trade is that the market's going to turn.
Okay, so you're protecting yourself, but you are negative. So listen,
I'm looking
I want
for
to
the
actually
move to the downside.
Yeah. So I kind of laughed at my buddy Odd Stats. Do you follow him on Twitter?
Yes.
Because I think the guy's hilarious.
Yeah.
And I'm going to quote him here because I think that this sums up the current situation. He says, "It's fucking incredible. Powell could sit down, look straight into the camera and say, 'Get long, people. We're juicing SPX to 4,000 and won't stop until that happens.' And 92% of the people on FinTwit would short the living shit out of it." And I completely agree that with Odd Stats there. This was an epic change in the Federal Reserve. And to fight the Fed at this stage, and listen, you might be right for the next little move down because we are way, way overbought. Okay, so there's no doubt about that. But having said that, this Fed has just gone batshit crazy. Like they really have. This is insane what they've done in terms of the switch.
Okay, but correct me where I'm wrong. Because to me, I don't see that they have started to accommodate. All they have done is stop draining the liquidity from the system. I mean, they stopped raising interest rates and they are going to stop shrinking the balance sheet. But that's not them reliquidating the system. What am I getting wrong, Kev?
No, okay. So 3 months ago, Goldman Sachs had 4 rate hikes priced into their projections.
Right.
And that's what the Fed kept hinting and trying to guide to. They are now guiding to 0.
Right.
Like they had, we've gone from 1 in 2019 to 0.
Okay.
Like this is crazy, like in terms of the amount that the Fed has changed. And so I look at this and everyone says, well, it doesn't matter. They've gone and they've raised rates too high and the economy is going to roll over no matter what. Because like in essence, isn't that what you're saying, Patrick?
Okay, but
no
okay,
matter
stop for
what,
a second.
Whoa, 1 second. No, 1 second. Let me stop.
Yeah.
Let me just go on. Aren't you saying that no matter what the Fed does, that stocks are still a short?
No. I'm not going to say whatever. I mean, that's a pretty, that's a pretty broad thing.
Okay. So what would it take for you? I'm asking you, what would it take for you to say stocks and are not a short?
I would
like how much more dovish would the Fed be for you to say like I don't want to short stocks?
So here's the thing: they could turn around and they could throw some liquidity back into the marketplace, but the question that what I want to demonstrate on some of these charts is what I think you would need to correspond with another rise in the stock market would be some significant reflation push. Something that, and it could be driven by commodities. It would certainly need yields rising, I think, and a number of other types of environments that would feed this. I don't think it's Fed policy alone, and this is where I'm going to fight you on this, because I think what I would need to see for me to start feeling like the stock market's bullish is I would need to see it in the other intermarkets. I'd have to see it in the way crude is trading. I'd have to see it in the way yields are trading. I'd have to see it in the way.
Crude is hitting new highs.
Okay,
like,
so
pull
let
up
me
the
show
crude
some
chart.
charts. First of all, I wanted to show this. The first thing I want to point out is this chart over here using the euro dollars. We're going 2019 Decembers to 2020 December. So what I wanted to just point out is that no matter what Goldman Sachs is telling me was putting on their dot path, the truth is that the euro dollar markets were already pricing in negative interest rates in 2000 or a drop in interest rates in 2020 through much of last year. This is not something that's new. The market knew that the dot path was bullshit. All right, and so
I don't disagree with that.
Okay, and so
the market was fighting the Fed, but you have to be aware the Fed was trying to put on the brakes. So 3 months ago in December, he was actively trying to break the market, and like he was doing that.
Okay.
And now he's gone. Anyways, go on. I don't mean to interrupt.
So here I want to just show you the chart. So the first chart we have up here, I just have the effective Fed funds rate through 1997 to 2000. And I have the S&P 500 on the upper end there. And what we had was obviously that 1998 crisis, right? The emerging market and the currency crisis and all that stuff. The S&P 500 dropped 22%. And there is an echo because we had a 20% drop, right?
Right.
And then the stock market turns around. They did cut interest rates back then. Not just pause, but they cut.
Yeah, no, you're right.
And then the stock market rips 69% to the upside in 18 months.
Okay.
Right? And so you're trying to tell me that this is what you believe there's a real genuine chance of happening.
Yes.
Okay. So
I think that you're bang on correct, and that we
so
could
I
get
completely
a situation.
disagree with you. So, but this is what I just wanted to make sure, because look, you know what, I can, as a trader, you know, this is the way Tony Greer even said it, right? As a trader, I'm trading the unfolding reality. Right now, I'm bearish, but if you're proven right and I'm proven wrong, I'm going to have to change my stripes and trade the market. I'm not going to fight it like a dumbass.
So I completely agree, and that is what I'm saying. That's what I guess what I'm saying to you is, what would it take for the Fed to do to get you to be bullish?
Okay,
because to me they seem to be like batshit crazy.
Yeah.
Like going all, like they can't be any more bullish.
So
they somehow found a way to be more dovish than the market was already expecting.
So I want to go back to 1997 to 2001 and look at a few of the other major macro markets. So what's interesting is that also at the back half of 1998 became a short-term dollar bottom, and the U.S. dollar index rips from the low 90s to 100, almost 120 to the upside. One of the most epic dollar runs to the upside. So now if we're drinking the Brent Johnson milkshake theory Kool-Aid, if we're thinking that we're going to have a dollar rally at the same time as the stock market, which is all possible, but that's definitely that narrative, right? Am I correct?
Okay, I don't think the dollar. I think the dollar rising too quick actually causes problems. But anyway, let's go on.
But we're just going to history. We're just talking history.
Yeah.
And so this is the other big chart. In 1998 was the bottom of crude oil, near $10, $11 a barrel, and from 1998 to 2000. Over the 2 years, we saw crude oil basically go 300 to 400%. Went from $10, $11 to almost $37 on the upside in just 2 years. An epic push on the upside, not just a rise from 40 to 60, but that the equivalent would be going from 40 to 160. If to compare to what happened in 99 to 2000. Do you contest that? Does that make sense?
Yeah, I agree.
Okay,
go on.
With that crude oil push came a surge in inflation, and that caused yields. The 10-year Treasury yield rockets from 4.25 rounding to almost 7% on the upside. A pretty hefty hammer down on bonds. To me, that real bull scenario is not just about the Fed and what the Fed is going to do, but I think that in order for us to truly have another major bull leg higher, I think that a lot of these intermarket scenarios that are currently prevailing trends would have to derail. Right now, we have a huge push higher in bonds as yields are dropping to new lows. Crude oil, I think it's going to roll over here. That's just my opinion, but I don't drink this new bull market in oil shit at all. And so to me, I think that a lot of the other variables that are in the market, none of them are supporting it, and all you're trying to do is basically that Fed just basically takes their foot off the brake, and suddenly the S&P is going to find the liquidity to surge up another like 50% to the upside. Not buying it. Not going to do it.
Okay. So to read this correct, that you basically are arguing that the Fed went too far and that just easing their foot off the brake isn't going to be enough to reliquify the rally?
Totally.
Okay.
I'm in that stance.
So I agree with you to some extent in that I am not 100% sure that this is going to be enough to reliquify the rally. But having said that, I don't know how much more bullish or dovish the Fed could possibly be. This has been shocking.
How about going
how
back
much
to zero interest rates and pumping new
listen,
QE?
They can't do that. Like they're not going to do
that. They're not going to do that right now.
But what's important is versus expectations. And versus expectations, this was one of the most dovish moves around.
Yeah.
Like if I told you that if I told you in November that the Fed was going to be doing this in March, you would have told me I was insane.
But
and
if you go back to what I was saying in October, November, I was based on what the euro dollar futures and all that stuff were saying, was I was the one standing there saying there is going to be no rate hikes in 2019.
Yeah, no, I agree with that.
But the market was pricing that in, no matter what the Kool-Aid of what the
I agree.
was.
But what I'm saying, well, you're just arguing that the market gets it wrong, and I'm saying that maybe you're wrong about the fact that just because commodities and stuff haven't rallied yet, maybe you're still wrong, and you expect too much of it too quickly. I just don't know how much more dovish the Fed could possibly be. You know, I'm gonna pull up a Hedge Eye kind of tweet that he put, and he put
was it Keith?
This is Keith, when he was taking his nice pills. So he says Powell in 8/24/18, so to August of 24th, 2018. He goes, if strong growth in income and jobs continues, further gradual rate hikes will likely be appropriate. Fed raises rates 4 times in 2018. Then he puts in March of 21st, like yesterday, he says, Powell says, you have strong labor markets, rising incomes. Yet he says no rate hikes in 2019. So stop and think about that. Powell is saying to you that the market is strong still in terms of the labor market, and yet he's now pricing out the hikes. So you're saying it doesn't matter that he's pricing out the hikes. And in fact, a lot of people on Twitter are trying to argue that because the Fed is pricing out the hikes, there must be something really wrong with the system. These jokers don't have a clue what they're doing. They don't have a clue. So I don't buy that you should sell stocks because the Fed is worried about something. And that's what I see over and over again.
Okay. You know, I'm not. Here's my key thesis that I've continued to share on it, and I'll continue to do so, which is that this time around, the recession is not going to originate in the U.S. It's going to be a global economic recession, and that the problem points are not the U.S. and the U.S. economy, and looking at all these metrics in the U.S. economy. It's about the fact that the rest of the world is actually slowing into a full-on recession in Europe in China. Well, maybe not a recession in China, but a full-on slowdown in China, and big problems here in Canada, in Australia, and everywhere. The whole world is slowing, and what the U.S. is not going to be in a little bubble in isolation, independent of the rest of the world. And the Fed taking their foot off the brake isn't going to stop a global economic recession.
Okay, so I understand where you're coming from. I'm not as convinced as you are that that's the case. And I, at the very least, think that we should wait to have judgment on it. I don't know how much more dovish Powell could be. Mm-hmm. And you know, what was the guy that used to say, "Don't fight the Fed"? Right. What was his name? I can't even remember his name now. Too many beers. But anyways, he would always say, "Don't fight the Fed." And I think at this point that we're looking more and more like 1998. And why don't you pull up one of the charts that I gave?
This one right here.
So I see, this is Friday. We're taping this, and I have seen so many things on Bloomberg and I'm assuming it's on CNBC as well. Although I don't watch that show. Yeah, about how the 3-month, 10-year yield spread has inverted, and therefore you should sell stocks. So there, I pulled up the chart that the Bloomberg TV anchors were nice enough to make, and you can see that in 2000 it inverted hard, and then a recession came kind of, a year later or something, and then in 2006 and 7, same deal, and then a recession came a year later. Okay, then I pulled up that little circle that I showed you is 1998, and that's that it also inverted. And there was no recession, and then the next 2 years, the stock market screamed higher. I think it looks so much like this in that the Fed. I think that the Fed was the main reason that the economy and the stock market was slowing over the past year. And I think that now that they have gotten out of the way and Powell has become full Neil Kashkari, I think that it's going to be. There's a chance that we rocket higher like we've never seen before. And I think just like the market... Okay, so 1 second. So just like the market tested him on the downside, remember they tested Powell on the downside to see how much pain he could take. I think there's a chance they're going to test him on the upside now. Meaning that he was trying... I really believe that he wasn't worried about inflation when he was raising rates over the past year. I don't think that he ever thought inflation was a real concern. I am convinced that what he was worried about was another kind of bubble that then pops and causes more pain. Well, and I think he came to the conclusion.
Let me tell you something about 1998. All right, we're going to go back 20 years here. And in 1998, there was no negative interest rates. There were no zero interest rates. The massive global debt problem wasn't that crazy. Yeah, there was overvalued tech companies in '98. That's what would and they were in bubble territory. But all of the structural issues that exist today were nowhere near as prevalent in '98, and there was a lot more fuel to drive it, and certainly there's a lot more global fuel that arguably could have driven it in '98. Now, I don't think any of that materializes. I'm taking the other side of your trade 100%.
Okay, bought from you, buddy. Because I think that there's a chance that we explode higher, and this gets out of control. And just like Powell was worried about trying to stop the creation of another bubble, I could see that this just takes off without him, and that he will ultimately prove correct in that he should have been more worried about a bubble, and the bubble that he was trying to avoid will be kind of created on his watch. And I just think that you might be right. It might be he raised rates.
We're on the show to shame each other. So one of us is going to get a public flogging for this.
But listen, you, just because the next kind of week or 2 weeks goes down doesn't mean that we're going to be correct. I'm talking about let's see where we are in the summer and in the fall. Oh yeah. And I'm actually more worried about a 1987 style kind of market than I am worried about a 1998 style market. And 1987 style would be a big, huge rally from here and then a crash. And I could see that happening as well.
Well, you know what? The one interesting thing that I'm personally gonna watch. Like, listen, where I will concede that something, and you know what I do like about the level of this market right here is that he did it very close to the all-time high. And really, if the market breaks and sustains at 52-week new highs or multi-year highs, then there will have to be me admitting that you may be right. But you know what? And it's not going to take another 20% rise in the stock market for us to get this tell. So let's see whether or not the market going into the summer can break those highs. I see that this is an opportunity. I'm still playing it to the downside. But let's
one last thing. One second before we go on. I know you're trying to get us to one last thing. If you look historically on a kind of a seasonal basis, the week after March expiry is one of the most consistently negative weeks around.
Sure.
So the fact that we didn't, like, everyone's looking at today on Friday and saying, oh, God, it's terrible, blah, 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 blah. The fact that we didn't collapse, I think, is actually more bullish than people realize. And that's just something I'm throwing out there.
We were very overbought. And so when such an overbought condition, it could drive selling. But you know what? I still think that if there was any reversal in today's price action that caused the market to reverse, it'll be next week's price action that will be the real tell. So let's see how that trades. It's certainly something for us to keep our listeners up to date on. So time to move on. And I want to get to what I think is by far one of the most interesting events in this week in trading history.
Okay. What is it, Patrick?
Well, it is the United East Indies Company, or known as the Dutch East Indies Company. And it was the first company to ever become a corporation. It was in 1602. By the way, check out this logo. It's the VOC is the acronym for it in Dutch. I like that. That's the first corporate logo ever.
I didn't realize it was the first company to be
first company ever. So let me just go through. I'll tell the story in a second. But here's some of the thing. First corporation, first IPO, first stock exchange. The first to colonize Cape Town. They're the ones that discovered New Zealand and New Holland, which was later renamed as Australia. Like and the largest corporation on inflation adjusted that ever existed.
Whoa, Australia was called New Holland?
New Holland when it was discovered.
I had no idea,
New Holland and New Zealand, and New Zealand stuck, and New Holland was renamed Australia.
Oh, I didn't know that.
But this is a big deal, and I love this story. The more I researched it, the more I was fascinated by this. So let's kind of go through all of this, right? So it's the Dutch East India Company. It was March 20th, this week in history, in 1602. And so just to put that in perspective, you take where Napoleon was, and the Mississippi bubble and all of these, and you have to still go 200 years earlier. So those are like the midpoint. We're going to 1602. And there was a huge and fierce competition in Europe for trade, obviously, and mercantilism and all these different things. And the English formed a cartel, the English East India Company type of thing. That was more of a cartel. It wasn't a publicly traded corporation or anything. And at the same time, the Spanish took away the ports they took over Portugal, and they took away the major trading port in Lisbon away from the Dutch. And so the Dutch were getting squeezed on every end, and the merchants in Amsterdam basically got together, and rather than working independently, they all came together and they created what is the very first corporation that has ever come to existence. And all corporations that we know today were originated from that. And more importantly, they created the shares. And the shares were traded, what became the very first stock exchange to ever exist.
Wow.
So not only was this the first corporation, but then the first IPO then, but it became the first stock exchange to trade that. And just some amazing stories. They obviously had their own military power. They were able to coin their own money. They even had the power to enslave people. It was like the craziest power corporation that existed. But what was crazy about this is at its peak, it had, on an inflation adjusted, a market capitalization of over $8 trillion, which makes it the largest corporation that ever existed still to this day.
That's more than Amazon.
More than Amazon and Apple combined at their peaks times 4.
Holy smokes. Wow.
Like this is absolutely crazy. So what they were doing, they had to circumvent and they had to create their own trading routes into the East Indies, to India and everywhere else like this. And so in the process of doing so, they were the ones that from Turkey or wherever it was brought tulips back to Amsterdam. And it was 30 years later that on those very stock exchanges that the famous tulip bubbles. I don't want to get into tulip bubbles because I think that in itself is a whole story we've got to cover in This Week in History. But the origins of the tulip bubble all come from not only the East India Company, but the very exchanges that and the stock exchange that came to existence there. Isn't this amazing?
So when we look back at all these crazy IPOs and stuff, we can blame the Dutch East India Company as being the start of it all.
It is, but there's even cooler stories than this. I'm not even done here. So this Isaac Lemery was on that exchange the first person known to on record to be the first short seller to ever come into existence. And in his process of going short, he was first recorded investor to seriously consider corporate governance. In 1609, just 7 years after this company was formed, he petitioned, created, it was the first form of shareholder activism that came into existence. He charged the VOC's board of directors for all of these accusations and petitioned for the liquidation of the VOC in accordance to standard business practice. Like this is all first stuff that ever happened. Everything we know.
Sounds like a real dick.
He does. But it's just amazing. So first short seller, first shareholder activism, all of this has originated from this. And the company basically went bankrupt in 1799 because of some problems. But what I wanted to just show, here's some pictures here. So they still have in the downtown the original headquarters of the VOC and the Dutch East India Company. And
really?
Yeah, it's still there. And more importantly, when you go and to downtown, in the red light district of downtown,
Nice.
where back in 1800 they had to rip down the original exchange and they rebuilt it, the Bourse van Berlage or whatever they call it now. But now it's just a conference center that was rebuilt. But that's the location of the first exchange ever and of where the first shares were ever traded. Of the largest corporation that ever existed. So when all our degenerate listeners are back in Amsterdam the next time in the red light district, make sure you walk by there and enjoy that little piece of history.
Come on, our listeners are much too sophisticated and not at all degenerate enough to go to the red light district.
Well, everyone's a tourist. Everyone's a tourist, right? But
there you go.
But isn't that a great story?
That's a great story, man. That is awesome.
And you know what? That inspires me. We have to circle back. I got to find some sort of a date we can pin to a week for the tulip bubble. But we have to talk about this because now that we've kind of created this kind of foundation, it's going to be a great story to talk about in our tales.
Sounds great. Well, thanks for sharing that with us.
Kev, let's jump right into what definitely my favorite part of the show is like you're an artist when it comes to putting these amazing clips together. Like I'm always intrigued every year, and I'm sure a lot of our listeners are, to see what you come up with each week. So listen, give us a little primer. What are we going to get into, or should we just watch it? What do you think?
Well, no, let's talk about it a little bit. I saw on I was away this week, but I kind of was going through some of the Powell press conference, and I noticed he talked about Wells Fargo and his euphemism for a risk management series of breakdowns in risk management was just too much for me to take. So I kind of made a little homage to Wolf of Wall Street with. All
right, well, let's not spoil it. Let's watch.
Okay, let's watch.
What happened at Wells Fargo really was a remarkably widespread series of breakdowns.
Enter our new securities attorney, Manny Riskin.
This is the SEC.
$700 an hour to be the voice of doom.
Listen to me.
Really in their risk management apparatus, which resulted in significant consumer abuses, let's say.
You piss up the SEC's leg, you end up with your tits in a ringer.
Do you not worry about it? I have the SEC under
What the fuck are these imbeciles doing?
And as it's gone on and on, it's become clear that, I think some time ago became clear that these are deep problems that...
Hey, what are you doing? Hey, we got the SEC in here. 15,000
needed to be addressed in a fundamental kind of a way. So there's a lot of work to do on that. And we put in place really an unprecedented sanction in the form.
Look, I know you're not following what I'm saying anyway, right? That's okay. That doesn't matter.
We will not lift that until Wells Fargo gets their arms around this, comes forward with plans, implements those plans, and we're satisfied with what they've done. You know, our main supervisory focus is on the company fixing its risk management approach and fundamentally rebuilding that approach. We don't approve individual pay packages. We do supervise boards of directors for having a set of compensation practices that don't reward short-term risk-taking and that sort of thing. And we will supervise based on that.
The real question is this: was all this legal? Absolutely fucking not. But we were making more money than we knew what to do with.
You know, Kev, I got to go back and watch that movie. It's been too long. What a classic.
Yeah,
right?
Actually, you know what? I was watching a show the other day, and it was actually an interview with Matt Damon, and he was talking about the fact that what was his movie with Ben Affleck where he talked when he was in Boston? What was the movie when they were kids and
Goodwill?
stuff? Good Will Hunting. And he was talking about the fact that when they originally made it, they decided that it was rated an R. So the studio came back to him and said, maybe we should figure out a way to make this, N14 or whatever, 14A or whatever it was. And they said, okay, great. And he says, one of the issues is that you can only have 3 fucks in an email. In a movie for it to be rated R. So they says, great, well, we'll just cut it down to 3 of those. And then they said, well, how many do we have? And he says, 147. So I was just kind of laughing about that. So then I was curious. So I Googled it, and I pulled up like the top movies in terms of the amount of F words in it. And when you know it, Wolf of Wall Street right up there.
Well, the language, if we use that much, we'd lose our listeners. It was, but anyway,
it was actually kind of funny because it was a lot of Scorsese movies would win. Like, what do you think that Wolf of Wall Street was number 3?
Okay,
unbelievable, and then Casino. Anyways, listen, it was a great movie. It's a terrific movie, even if you have to kind of do earmuffs the whole time and stuff like that. It's a fun movie to watch.
And but enough about the movie though. How about Wells Fargo?
Yeah, it's those jokers just make me laugh. How they can to claim it was a breakdown in risk management is such BS. Everyone in the top knew what they were doing, and the fact that Powell is spouting this bullshit and saying that covering up for them, and isn't that one of Buffett's big holdings?
Yeah.
And isn't he always the kind of holier than thou guy and stuff? And shouldn't he be selling it based upon the management? Anyways, don't get me started. I just the banksters once again are kind of at work, and I don't even want to go there.
Would you pair it with a long short against one of the big like a JP Morgan or anything, or is it just?
I have no idea about the price of it
Yeah.
and stuff. I do believe that they knew exactly what they were doing, and that I guess I that might be slanderous, but I suspect they knew exactly what they were doing, and that there was absolutely no breakdowns in risk management. It was designed that way.
Well, you heard it from Kevin here. All right, so let's move on. Top 5 things to watch next week. But before we do, we got to review our top 5 from last week. And I personally feel the number 5, you nailed it. I mean, with Goldman Sachs, they did nail the top. Obviously, Powell had a little bit to do with it. But I think them embracing business casual did mark the top. And so
that won't that be funny if that ends up being the top?
Oh,
and that was definitely my pick. I definitely put the Goldman Sachs in there, even though it's not embracing business casual as much as they say it is. But I agree with you that could be the it'll be ironic if that ends up being the top.
So number 4, utilities. Will the chase continue? We were convinced we were going to Hulk smash this, like we have this notorious thing of doing, but no. Like, I mean, the market broke down today, and utils are trying to punch new highs.
Yeah, well, there you go, because the bond market's been on fire. So listen, if those things couldn't go up in this market, then we got real problems.
The bond proxy trade still works, right? And and they're moving. So does the VIX break to new lows? Well, it's certainly not today.
But I was looking smart till today. Like that was one day was ugly, but it was early in the week. It did break down to new lows.
Yeah, and so earlier in the week was when I was putting on some calendared straddles on the S&P, and one of the reasons why I felt it was timely to do it then was because the vol was so low, right? And
so I have a question for you: higher or lower in vol from here?
Look, my narrative is that this is a bear market rally, and vol conditions during bear markets are higher. So I don't think we're going. Look, it could still take a month or more for the big rollover. I'm in no way, but please don't misinterpret me that I think it's just a straight line every day down from here. There is a very good chance, the way we talked about it in the last few weeks, was that we may spend the next month or two just sloshing back and forth. And during that time, vol could come right back to the bottom of the range. But generally, I don't think we're going much lower than 13. I mean, maybe like it would print 12 or something, but I don't think there's a lot of vol risk here. At least.
Okay, so here I'll tell you something. I think we're gonna print a 10 handle this summer.
Oh Jesus! Oh,
there you go.
No, oh my God. Okay, well we'll see. We'll see what happens, but I'm not in that camp. Anyway, do you know what happened with that Euro area consumer confidence?
Oh shit! It was terrible, and it was a big function of why we went down today.
But don't worry. The Fed will save the day and take the markets up another 50% because the euro doesn't matter.
Well, listen, I'll tell you one thing. I have come around to the idea that the Europeans are making a complete mess of their financial and economic situation.
I don't think they have many choices, though.
I think they do. But anyways, that's another story for another day.
And of course,
I think this idea that you can fix things with even easier monetary policy with no fiscal is absolutely asinine. This is the stupidest shit I've ever seen a central bank do. It is just nuts. And they seem to think that they can fix things with even more kind of monetary stimulus and even more fiscal austerity. And there is no way this is going to work.
Why do you need fiscal stimulus when you can create growth through immigration?
Yeah, well, listen. So I just think the fact that we had this terrible, European or specifically Germany, it was a German PMI that just shit the bed, and that's being
they are
polite.
on the verge of a recession. Are they officially printed a recession technically?
Well, I don't know if they haven't printed a recession, but this PMI was well below the manufacturing PMI printed at like 44. They were expecting 49. It was one of the biggest misses we've seen in ages. The European economy is just terrible.
Europe will be in a recession. There's barring some big stimulus that somehow saves the day. I feel that Europe, it's going to be hard to avoid a recession. We'll see.
And all their pro-cyclical fiscal policies, which means that they're going to have to cut as they go into recession, is just just boggles the mind at how they think they're going to get out of this by cutting even more into the kind of a demand-led, problem. So. I just until they do something different, and I don't see anything changing. And the only thing I can say is, the more this stupidity continues, the more likely is that we're going to get a very dramatic change in policy by a political force.
Right.
So we're going to see, some very, very anti-EU, whether it be in Italy or somewhere else, or something's going to happen that's going to push it from a political point of view, and it's going to all of a sudden it's going to throw a lot of excitement into the kind of the markets in Europe.
All right. Well, listen, number one was FOMC, but I think we beat that horse to death already. So let's leave it at that. So let's move on to what we feel are the top 5 things to watch next week. And so number 5, I wanted to just mention oil. A lot of people are getting excited about rising oil prices, but there's a major overhead resistance coming. Now, obviously, the $60 round number has initially, the oil just bumped its head, but that's far from a technical reversal. That could be north of 60 tomorrow morning, right? That's nothing to think. But
Patrick, one second. I hate to tell you this. Tomorrow morning, it's not going to be 60.
Yes, it is good. Monday morning. Fuck's sakes.
Okay, there you go, bud.
Yeah. You know what? I had one too many beers, whatever. I'm gonna wake up in the morning. I'll be, why is the market not opening? It's
That's right.
But look at that 200-day moving average. I'm not to be honest, while I'm a technical analyst, a CMT, all that stuff, I'm not a very big tracker of the 200-day. But
seriously, you don't like it?
I don't make trading decisions off of it. I don't.
Oh, really?
But it's worth knowing what everyone else thinks is important. And there's a ridiculous amount of people that track the 200-day. So for me to know where the 200-day is, there's liquidity considerations where a lot of traders make key decisions at those levels, right? Because of that, you can see that 200-day moving average is more or less coming in around 61.80 here on this charting on the on this continuous oil contract. So we're at a situation where we're just a few dollars away from not only the $60 round number. I don't think oil beats, even if it temporarily breaks above the 200-day. I don't think we spend any sustained period above there. If my intuition is right, this is an important technical level. I'm not short oil yet or anything like that, but this is a level to watch.
Patrick, you know what? I was Googling it because you told me you're a CMT, and I didn't realize you're so much into country music. I looked it up. Country music. Country music television. I didn't realize that there was some sort of designation for that, bud.
Yeah. No,
Okay.
You're a fucker. Anyway, let's move on. All right. So number 4, I wanted to touch on Canadian banks. Not just mine and your opinions about Canadian banks. Here I'm going to just put the XFN, which is the iShares TSX Canadian Financial Index. You can see what a monster V rally that's had, right? But guess who is doubling down on his short on Canadian banks?
Steve Cottrell.
Yes.
I can't even pronounce it.
Eisman, buddy.
Yeah, but that's
Steve
Cottrell,
Eisman. He so The Big Short, another great movie, but he is right there aggressively calling for a big mean reversion. I mean, he goes out and he says that this is not a repeat of 2007, 2008. But he's basically anticipating that there's a lot of downside in the Canadian real estate market and all of this, and he's of the opinion generally that this is going down. And we had obviously a big sell here. You think Powell's going to also save the Canadian banks?
No, I think it.
Well, come on. If that's
the guy from Office will do, actually, he might be right on this one. This might actually, and the only difference is that, one of the things that I think you have to keep in mind is that just because Canadian banks go down doesn't mean it's going to be a repeat of 2008. And as long as you keep that in mind, there's nothing wrong with saying that Canadian banks are going to underperform many other financial kind of companies throughout the world.
Yeah.
Because let's face it, we're way over indebted from a kind of consumer point of view. Our real estate market is up on a stick. There's just no way it can continue. I thought Trudeau was actually going to, on this recent budget, was going to do more to juice the economy and the market, and he actually kind of, I don't know, it's kind of blah, don't you think?
Yeah.
Like it wasn't really that big a deal. I have long contended that American banks are a much better buy than Canadian banks, and that you should be buying U.S. banks and shorting Canadian banks.
Oh, I just gagged a little in my mouth, but we'll see.
Why? Why?
No, you know what? Your point's not right. Well, look,
Yeah.
I just don't think I want to buy any of them, to be honest. But if you want to do the long-short combination, I would probably say I would take your trade if you're going to pair them.
Yeah. I still think that Australian banks are even better than Canadians, though, on the short
Oh,
side.
yeah, you just love to hate on the Aussies.
Come on. I love Australians. They're the nicest people. I love them. But just because their banks and their real estate market is even more preposterously priced than Canadian real estate and banks, like that, why? Like it has nothing to do with like the people. It has everything to do with the pricing.
I know. But you weren't. I'm just saying, like, yes, you know what? Like Grant Williams and other guys like that have been coming on and really putting a lot of emphasis. I mean, Jonathan Tepper and a number of them have all kind of voiced their big concerns about what's happening in Australia. But I think Canada's going to have its fair share of issues. But anyway, let's move on to number 3. And number 3, we wanted to talk about. I just wanted to touch on the currencies, right? Because the euro, the Aussie, and the CAD continue to demonstrate rather weak price action. We had the Sylvester Stallone clip on the cliffhanger when the euro made that break a couple weeks ago below the 1,300 level. And is he going to hang on? Well, initially it's held. But, boy, I just feel like the euro looks like shit. Like this really, in my mind, is still highly vulnerable for a breakdown.
Okay, so I don't disagree with you that it looks like shit. But you made fun of me when I said the Mercedes-Benz Jaguar spread, and you didn't like that trade. Why don't you pull that up instead?
All right, just so you can shame me. All right.
Because I really think that there's a better trade out there than just purely short euros.
So,
euro pound, I think, is a better trade.
Even with the Brexit, with the Brexit pending a week from now, like, is there not too much political risk here? Like, too many lottery tickets?
Shit, we've been talking about the Brexit forever.
But now is a kind of critical crossroads.
Like, seriously, it's going to be 2022 by the time they settle the Brexit. I just don't think. I think there's a better trade in terms of being short something.
Fine. If you want to be short this, I'm not gonna stop you. Whatever. Like, it's like
either way. Listen, Europe is stinking like bad fish that you've left out on the counter, right?
Ooh.
Like, there's no doubt about it.
That's a low blow, man. That's
well, no, but like
fish.
the economy, their economy is terrible. So it would make sense that the euro is about to head lower. having said that, it's still kind of up in the air in terms of whether the U.S. dollar is really ready to take off. If you go and do the DXY, we haven't really broken out of the range. Every single time we get excited about it and you talk about it on the show, it comes back into the range.
Yeah, but that doesn't mean that well, anyway, okay, you're going off topic. I want to stick with the three currencies we talked about. So,
okay.
Canadian dollar, look how that rolled over. Like, I mean, it took no more than a week of trying to bounce off of its lows, and it's rolling right back down. We're below 75 cents. You want me to? Are you confused with this chart? Do I have to put on your USD CAD pairing?
Well, I was about to tell the real currency traders that.
Oh my God! All right, so here we go. We'll look at the traditional CAD, the USD CAD.
Yeah.
So, it temporarily broke down toward 133, and then it's now looking like it's going to potentially, the U.S. dollar is going to break out again.
I don't disagree with you.
And then look at the Aussie. That 70-cent level is like on the bigger picture weekly chart. So this is like a major support line. I mean, we give out 70 cents on the downside of the Aussie-U.S. pair. I mean, there could be a big currency trend that emerges. Anyway, so if there was a big U.S. dollar rally coming, it's these three very weak currencies that may very well be leading the way.
I can't disagree with you there, but wait 1 second. Go back to that Aussie chart.
Oh, there's no such thing as a bad tick shit? Oh, my God.
No such thing as bad tick.
Except for the yen. You think the yen's going to go right back up? How's your bad tick thing working on the yen? You think we going back up there?
For sure. No such thing as a bad tick.
Oh, Jesus. Oh, my God. If we give it a couple of years, you'll eventually be right. Jesus. All right, so number 2, Treasury bonds. I've been taking a lot of flack from you, but you know what? Being just long Treasury bonds feels pretty good, I'll tell you. You call I'm pulling a Gurvich, and then you're all fancy with your your 530 spreads and you're doing this, but you know what? Like, look at this chart on the 30-year. That looks not bad. And take a look at this 10-year. I mean, that's ripping, buddy. That's a bull market on Treasury bonds.
Yeah, listen, I can't argue with you there, but
I can't wait to cash in on our bet when Treasury bonds outperform the home builders, buddy.
Oh, God. Don't give me that shit. So listen, let's pull it up. Let's 1 second. I got to pull it up. Now that you've
you're still ahead. You're still ahead.
Yeah,
but I'm going to win. You are going to lose this bet. We still look.
And then you woke up and the bed was all wet. Okay, that was bad. But anyways,
no, it's funny. But Treasury bonds are ripping. The question becomes, where do you think the yields are going to? Do you think we're going to 2%? We had this debate. We already talked about this. I think we're going below 2. You said we're not going below 2, right?
No, we're not going below 2.
Yeah, and I took the other side of that bet. Holy cow! Okay. How are we going to track all of these bets?
Because we're going to track them. We got them going because
all our listeners.
I want to make sure I get all my stakes. I want to get all my stakes.
Well,
let's move on to number 1 there, buddy.
All right.
Yeah. Well, number 1.
U.S. GDP. I mean, I think the final GDP is expected to be 2.4%. Do you think we miss?
No. I actually don't think we miss. I think the U.S. is doing just fine.
I'm not opposed to that view. Like I said, I'm far more bearish on the world than I am the U.S. in terms of data, and it's just it's your little kumbaya that Powell is going to take S&P to 4,000 shit that you're like drinking that Kool-Aid that I don't agree with. But I still think that the U.S. economy will be the last one to roll over. So I don't think that this has to be a miss. I think it could probably come in line, but we'll see, won't we? That's what we're gonna watch. So let's parting words of wisdom, Kev. What do you have to share with us?
Okay, so this is for you, Patrick. The old saying, "The market exists to confound the majority and reward the minority," exists for a reason. I thought that was really good. Actually, I really like that.
Yeah, it is.
Another one that's very similar is that the market goes that it'll hurt the most, the majority the most.
Oh yeah, no.
So-
My way that I always describe it to my members, I always say that the market loves to play the role of the great humiliator, and we always kind of look at what scenario can the market do to screw over the most amount of investors, and that's a base case that you start with.
Oh, okay. So actually, that's a great point. Do you think that a rally or a decline in the stock market causes the most humility?
Well, I'd have to say that I feel that this market rally had to last long enough to convince everyone that was short to throw in the towel, aka
Yeah,
you.
like mopes like me, right?
Yeah.
Like, that's what you're arguing.
And so now that you guys have thrown in the towel, the bear market rally has done its job.
Touche, man. Touche. I agree with you. If it goes back down, I'll feel like a real heel. So I agree with you. Like, that is actually probably a good one. So on that note, we'll leave it. That is probably the most painful kind of.
So we'll see. You know,
development that could happen.
one of us is going to have egg on the face, and the other one is going to be able to parade the championship belt around and have
And
some.
and to be fair to you, you've been the most consistent. I've flopped around as Powell's flopped around. So if it is me, then it will be the most embarrassing. I will have more egg on my face than you.
All right, but listen, reminder to everybody. We're going to do that meetup. Those of you that are geographically able to make it to Toronto and want to come out for a beer with Kevin and myself after we tape Friday's Market Huddle episode on the March 29th, we're going to go to the Elephant and Castle, 212 King Street in Toronto.
King Street West.
And it's at we're going to be at the back of the bar. If you don't know what we look like, good luck finding us. Just the two drunkards that are talking markets. You'll just have to listen in. But join us. We want everybody's welcome. Bring friends,
For
whatever.
sure.
Just come and say hello, and we'll shoot the shit about the market. So make sure you come out to do that. Any parting words there, Kev?
Well, no, we'll be there by 8:00 though. Like, that's our goal. That'll be the absolute latest. So there's a good chance that we'll be earlier. But come out because it's going to be fun. And Patrick and I have kind of committed to get out and do a little drinking to make sure we keep up kind of the camaraderie. And it would be great to have some of our listeners join us as well.
All right. Well, so thank you for spending some time with us. Visit our markethuddle.com website to sign up for the weekly email that includes the link and the charts and everything that you want, updates as to when our next shows are. Rest assured, we'll never clog your email with junk or send you any thing beyond our weekly letter, just to let you know about our upcoming shows. You can also follow us on Twitter, right, Kev? Where can they follow us?
That's right. I'm at Kevin Muir, and you're at Patrick Ceresna. And for those that aren't kind of spelling challenged, it's Ceresna.
And our main one.
Yep.
Which is
at themarkethuddle.com. At the Market Huddle. Some guy got the at Market Huddle, so we have to add a the to it. So make sure you add the. And a big thanks to Bench Brewing Company.
Yeah.
Patrick, did you taste the what was it?
I did
Pine?
not. No, cedar, wasn't it?
Cedar. That's right.
It was cedar. I did not. Well, I guess you could argue that there might have been a hint of it, but it was all fruit to me. It was a very fruity drink, beer. And you know what? I feel less masculine saying that I was drinking a fruity beer, but it's
So this is what we hope. The next one is like a good pine or a tamarack or something like that, like a more manly evergreen. Anyways, thank you very much for spending the time with us.
Yeah, and
we look forward to talking to you next week, and have a great week.
All right, thanks everyone. Stick around for more Angie.
So we're in the after hours. Angie, I got some questions. I'm a Winnipeg boy, so I have some questions about canola.
Ooh,
so canola. I see that there's all sorts of problems with China, with Canada, threatening to not buy our canola and stuff. And I was wondering what you thought about the canola market and what you can kind of give us some insights on that and talk about, as a Canadian, how much we dominate this space or don't dominate the space, and we just kind of like to think we do, and talk about a little bit about the canola market.
Well, I'm a Michigander, so I'm like a junior Canadian. Like officially,
Okay.
I'm vice Canadian, like you guys. So that's what I feel like. And we trade a lot back and forth with Ontario. And I actually was just talking to a friend of mine from over that way. He's a big wheat trader. And he was talking about the China thing, not necessarily as it relates to canola, which is a big deal, but as it relates to soybeans, because one of the things that we saw this past year is that, I mentioned that during the show, is that China had been able to cover their needs this fall. Well, a good portion of their needs, if you look at Canadian soybean exports to China, they blew up. I mean, they were through the roof. And so I think, that is one interesting issue. And I don't want to get political on it by any means, but didn't we ask you guys to take that person and extradite her for us? So they're kind of mad at you for something. I feel like we're the playground bully, and you guys were our patsy, and they're mad at you for it or something. I don't know. And like I said, maybe I'm completely wrong in all of the political wrongdoings that took place to get us here. But yeah, I mean, it's a huge impact. It's entirely unexpected, I think, in so many ways. A lot of growers had increased canola acres this past year. Soybean prices had gone up, so had canola. Canola is considered a replacement for soybean meal. Canola meal, provides about 80% of the value of soybean meal when it comes to a feed ration there. So, yeah, that's ugly. I think you'll see it more in basis. Obviously, the canola market has fallen off, but it will find value if it gets cheap enough, especially with expensive as what soybean meal's been over here. You'll find folks feeding a lot of canola meal. So it'll find a bottom, and I think you guys will work it out. China right now, I think, is flexing muscle, in a lot of ways. And I think before this coming harvest, you'll probably work it out. But the one thing that's decent about a lot of Canada is that you guys have a little bit more flexibility when it comes to pulses and other types of crops. You can, avoid the canola a little bit better than, maybe the corn belt when it comes to soybeans and corn. You have a little bit more variety of potential growth. But as a whole, it'll be interesting to see how that works out, just simply because it was so unexpected.
Right. So I mentioned before how I was a long-term grain bull, and I look at the demand and I see the world demand just going up and up and up. And, a lot of guys a lot of people will talk about the supply, and they'll say, the supply is huge. It's our stocks are the biggest number ever. But as a percentage of the demand, it's nowhere near as kind of large as we think. Are the bulls that are kind of clinging to stuff to try to buy, are we just deluding ourselves? Is this just never gonna I want something to a reason to buy it, Angie? Can you give me a reason to buy it for the long term?
Well, I can give you a lot of reasons to buy it, but I can't give you any guarantee that I'll be right. I mean,
no.
And I think that's the thing. I think what you're saying is important there because, the bulls have been hoping to find a reason to buy it, but they've been burnt so much they're not buying it. Whereas the bears have found reason to sell it, and it's worked for them. And so,
do you think the weather has been? Am I wrong? Because I'm a relatively new grain trader. Over the last 5 to 10 years, am I wrong in saying that the weather has been more than perfect recently?
Yeah. In the last few years, it's been entirely benign. You are not wrong. I mean, it's been perfect. I lived out in north central Iowa, 2015, 16, and 2015, 16, 17, 18 production years, and they were about as perfect as they come. I mean, that's when we needed rain, we get rain. When we needed to stress the crop a little bit, we'd stress the crop a little bit. I mean, it just, you could not have drawn a map. I mean, you could make weather a little bit more better by putting it in a greenhouse. But aside from that, I mean, maybe you got a little bit too much rain here or there, or maybe you didn't get quite the rain you wanted when you needed it. But as a whole, from a production potential, when you look at yields, it couldn't have been better. So that's part of it.
So big picture, it was almost the perfect growing for the last, let's say 3-4 years.
Yeah. So everyone's been lulled into this false sense of security right now, I think.
Okay,
You know.
I agree with you, and you know what? One of the things that makes me laugh is that it seems to be those that the real experts. You're one of the few kind of people who really trade grains that are bullish, because I find most people that trade grains are bearish, and rightfully so. They've been knocking out of the park. But I look at there's a market strategist by the name of Don Cox, and he has a saying that he says, "Those who know it best love it least." And I think that that's like where we stand right now in grains, because they've been burnt the most. That's how I look at it. I have a question about the farmers. I see all these articles about them going, having financial stresses. How long can this continue before the farmers just end up getting a supply response because farmers are going out of business?
I think you're going to start to see that this coming year, to be honest. Obviously there's going to be people that are going to step in and replace the folks that are getting out. You have some that are going to throw good money after bad, but I think you will start to see some supply constriction take place this year. I would not be surprised to see it in next week's acreage number from the USDA, where the whole acreage pie actually begins to shrink, and you start to see people pulling some of these poorer producing acres out of production. I wouldn't be surprised to see that happen as soon as this year.
Okay. Well, Angie, we know we have to go, so we'll let you go. Yeah. Thank you so much for your time. It's been a pleasure having you on.
Angie,
and listen,
great.
Before you go, why don't you give a plug to where people can find you and tell us on Twitter or wherever that you want people to kind of go.
Yep, you can find me on Twitter at Goddess of Grain, or you can email me at citizenselevator.com. One too many sips of wine there. That's a hard word to say if you're, so you know. That's a little difficult every now and again. But yeah, so you can find me on Twitter on the most. If you want to see my ramblings and some smart aleck responses, that is the place to locate me.
Well, great. Well, thank you so much, Angie. It's a pleasure meeting you.
Angie, thank you very much.
Yeah. Thanks for having me. I enjoyed it.